We're about to crack the code on a language that moves literally trillions of dollars around the globe every single day. And no, it's not a programming language, and it's not a spoken one. It's accounting. It might sound complicated, but really, it's just the way every business, from your local coffee shop to a huge tech company, tells its financial story.
So think about this. It always starts with something small, right? A single sale, one purchase. But how in the world does that one tiny event ripple outwards, eventually showing up on a massive financial report that can literally make or break a company's stock price? Well, that's what we're going to do. We're going to follow the money, tracking one simple transaction from the moment it happens all the way to a major financial headline. But before we can start following the money, we have to get our heads around the one single rule that governs absolutely everything in accounting. And here's the good news. It's not about some crazy, complicated formula. Nope. It's all about a simple, elegant, and totally unbreakable idea of balance. And here it is. This is the bedrock of all accounting. I want you to picture a business as a perfectly balanced scale. On one side, you've got its assets. That's all the valuable stuff the company owns. And on the other side, you have the claims against all that stuff. Now, those claims come from two places: liabilities, which is what the company owes to other people, and equity, which is the value that belongs to the owners. And the golden rule is this: that scale has to always be in balance, no exceptions. So let's break that down. First up, assets. Put simply, this is all the useful stuff a business has. We're talking about cash in the bank, of course, but also the products sitting on the shelves, which accountants call inventory, and all the computers or machinery it uses to get the work done. If it has future value, it's an asset. Now, for the other side of that scale, we've got liabilities. Think of these as the company's debts, or IOUs. It's what the business owes to outsiders. That could be a bank loan, or maybe it's the money it owes to its suppliers for materials. You'll often hear that called accounts payable. It's basically a claim someone else has on the company's assets. And that brings us to equity. This is the owner's slice of the pie. It's what's left over. Imagine if the company sold off all its assets to get cash, and then used that cash to pay off all its liabilities. Whatever cash is left in the pile, that belongs to the owners. That's their equity. It's the true value of their ownership. So, how do you keep that scale perfectly balanced when business is happening all the time? Well, here's the really clever part. You can never just change one thing. Every single transaction has to have two equal and opposite effects. This amazing concept is called double entry accounting, and it's the engine that keeps that scale perfectly level always. All right, so we've got the theory down, that perfectly balanced scale. Now let's see it in action. We're going to watch how accountants use this whole idea to capture the story of a real business event as it unfolds. And here's our main character, a simple, everyday transaction. Our little company, Explainer Co., just provided a service and got paid $100 in cash. Seems simple enough, right? Well, for an accountant, this single event kicks off a very precise recording process. Now, to keep that scale balanced, accountants use two key tools: debits and credits. And I need you to forget everything you think you know about these words from your bank statement. In accounting, they just mean left and right. A debit is just an entry on the left side of the ledger. A credit is an entry on the right. So to make an asset go up, and remember, assets are on the left side of our scale, you use a debit. To make a liability or equity account go up, which are on the right side of our scale, you use a credit. They are the yin and yang that keep the entire system in perfect harmony. So let's apply that to our $100 sale. First, the company's cash, which is an asset, went up by $100. Since assets are on the left side of our scale, we record that with a $100 debit on the left. But at the exact same time, the company earned revenue, and that makes its equity go up. Since equity is on the right side of the scale, we record that with a $100 credit on the right. See? A $100 debit on the left, a $100 credit on the right. And our scale? It stays perfectly balanced. Okay, so that little record we just made is called a journal entry, but it's just the first step. Think of it like a single sentence in a diary. Now, the business needs to organize all those sentences into a proper book. This is where we go from just raw data to actually useful information. Here's the roadmap for how that happens. We just did step one, right? We recorded the event in the journal, which is like the company's daily diary. The next step is to post that entry to the general ledger. Think of that as the master library where everything is sorted. And finally, we'll use that library to prepare something called a trial balance, which is just a final check to make sure everything still adds up perfectly. So this general ledger, it really is the heart of the whole system. Picture a giant book, and it has a separate page for every single account. A page for cash, a page for sales, a page for loans, you name it. Our $100 transaction gets posted to two of those pages, the cash page and the sales revenue page. It becomes the one central source of truth for the entire company.
Now, before they create the big official reports for the public, accountants do one last check for themselves. That's the trial balance. Its only job is to list out every account from the ledger and prove that the grand total of all the debits equals the grand total of all the credits. It's like the accountant's private dress rehearsal, while the balance sheet is the official opening night performance for the public.
All right, we've followed our simple $100 transaction from a single entry all the way into a verified, balanced system. Now it's time for the main event, turning all of that organized data into the three key financial reports that tell the world exactly how the business is doing. First up, we have the income statement. This one answers the most important question of all. Did the company actually make any money? It takes all the revenue the company earned over a certain period, subtracts all the expenses it had, and what's left is the famous bottom line. It's net profit or loss. This tells you all about the company's performance over time. Next up is the balance sheet. And if the income statement is like a movie, showing you the company's performance over, say, a whole year, then the balance sheet is like a single photograph. It's a snapshot showing exactly what the company owns and what it owes on one specific day. And just look at those key elements. Sound familiar? It's our accounting equation all dressed up as an official report.
And finally, there's the cash flow statement. This one is so important because profit on paper doesn't pay the bills. Actual cash does. This report shows exactly where the company's cash came from and where it went. It breaks everything down into three buckets: cash from its normal operations, from investing, and from financing. This report is crucial because a company can be profitable and still go bankrupt if it runs out of cold, hard cash.
And here's the thing. These three reports aren't just separate documents. They're all deeply connected. For instance, that net profit number from the income statement, it flows directly over to the balance sheet and gets added to the owner's equity. They all work together, constantly checking and balancing each other to tell one complete, consistent story. So we've got this incredibly powerful language for telling business stories. But, for any language to actually work, everyone has to agree on the rules of grammar. And that's our final piece of the puzzle. The rules and the referees that make this entire system something we can all trust. And these are the two main rule books. Here in the United States, companies follow something called GAAP, but for most of the rest of the world, they use IFRS. These principles are what make sure that when one company says revenue, it means the exact same thing as when another company says it. It creates a level playing field so we can actually compare them fairly. And who makes sure companies are actually following those rules? That's where auditors come in. Internal auditors work inside the company, trying to find and fix problems. But for real public trust, you need external auditors. These are independent third parties who come in, examine the books, and give their professional opinion on whether the financial story the company's telling is fair and accurate. So we end right back where we started. Accounting really is a language. And just like any important language, it needs rules of grammar. That's GAAP and IFRS. And it needs editors to check the work. And those are the auditors. It's this whole system that allows investors and all of us, really, to trust the financial stories that businesses tell. And now, you know how to read them.